Hi everyone, this is Sam from ONG Capital. One of an investor's favorite tools for evaluating a company is the PE ratio. It measures the current share price relative to its per share earnings. If a company has a high PE ratio, it could mean that they're overvalued or that investors are expecting high growth rates in the future. But with extremely low interest rates set by the Fed until 2022 and bond market investors moving their money into the equity market, higher PE ratios could be the new norm for the next few years. Historically, the S&P has been valued at around 15 times its net earnings. Right now, it's almost double that at 28. A short-term reason for this is that the current bull market is enticing new investors to heavily focus on some of the large-cap safety stocks. A long-term explanation for this is that low interest rates have decreased the risk premium and allowed companies to optimize their balance sheets. They've been able to increase their earnings per share by borrowing money and using it to buy back shares. A lot of companies are already over-leveraged and can't do this, but for tech giants like Apple, Google, and Microsoft, the surplus of cash on hand is plenty to keep repurchasing and borrowing for years to come. Low interest rates means more spending money in consumer pockets. That also means they may be willing to make larger purchases and borrow more, meaning banks can benefit off of a higher loan base rather than a reduced net interest income. While the rest of the market has been trending towards optimism, banks have been priced for a depression, making them attractive buys right now. TFS Financial is still around $14.30. It made its way up to $22.50 earlier this year, and nothing of significance has changed. It has a low-risk, low-reward loan book focused on midwestern housing, positioning itself extremely well in a recessionary environment. The dividend is safe and will likely climb again in 2021. Thanks for watching, and don't forget to follow ONG Capital on LinkedIn, WeChat, and now as well on YouTube.